Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day-to-day so we can design a business that gives us a life of independence. If you're wondering how you can hire premium A players as a CEO or any executive, and you're wondering how do I tie them to my cash flow and equity valuation goals, this is the episode to listen to. I've had Craig Rutledge, one of the partners at VisionLink, on the podcast a couple times, and he is going to be breaking down, and I'm going to be geeking out with him on the specifics about how to pay executives on a short-term bonus program, from working capital to distributions to normalized EBITDA, and then also tying them to the long-term equity growth goals and all the different ways you can design a plan that completely locks you in with someone that is going to be caring about your business and your asset just as much as you. If you want to know more about Craig and VisionLink, check out the show notes below. Otherwise, without further ado, here's my conversation with Craig Rutledge. Craig, very excited, man. How are you doing?
Hey, doing great, Ryan. Great to see you again.
Yeah, likewise, man. So what I was thinking, like I was just telling you, is I'll put a container around this for the audience. A lot of this is also for my clients and the new Independence by Design framework. And your methodology, your approach, I mean, I found myself talking about it to everybody. And so it's like, okay, let's get you on the podcast again. Let's dive a little bit further in. You guys have had some updates as far as like how you're delivering your offering, which I think is awesome. You guys are also working on not just the executive comp plan, long-term, short-term, but also even like I don't want to call it the rank and file of the, other employees. But like, Craig, what I'll do just for both of us and for the audience is to put a container on, okay, what's the process? What's the problem that everybody I'm talking to is dealing with where you and VisionLink become very obvious as a need? And it is this, with the Independence by Design framework, there's 3 steps: understand the game, choose the game, and then play the game of ownership. And this is, Craig, where ownership and leadership alignment take place. And I'm saying this because in like VisionLink, right? It's the name of your guys' business. So like, again, there's so many things that have kind of been syncing up. Okay, so ownership's goals need to dictate operations. And so many times I had a buddy of mine who runs a $10, $20 million business. And he's like, the inmates run the asylum and I'm sick and tired of that shit. And so, because they get into these meetings and they're picking plans and it's like, okay, well, what does this mean to me as the owner? And then by flipping this on its head, saying, okay, if someone as an owner wants to make 250 to 500 grand in income through distributions, like that's their income goal and their target equity valuation, they have to pick a time and say, okay, well, let's say it's $5 million in 36 months. Or maybe even going from 5 million to 7, whatever that is, there's this peg of income through distributions and target equity valuation. And Craig, I was on the call twice in the last 24 hours with some of my clients where they're like, it's the CEO job that they need to replace, where they're the ones, even though it might not take a lot of time to actually be in the business, they're the ones fully responsible for everything. Like one of my clients, he said, costs went up 5%. Okay, like who's else going to look at that? I'm like, well, it's because you have to have a CEO that's looking at it in this 3-statement model. And when I say this because it's like, I want to tell you what I've been saying to them based on our last conversation, then I'll shut up. Is like, okay, if we need to have someone that we pay him, well, let's assume we can find the right person. I think we should use your philosophy to go recruit the person. Actually, I think you're first. And it's like, okay, if we go find, let's say it's me, Ryan's 200 grand. He wants to make 250 or 300 annual income through cash. How do we align him with my clients who want to have to replace their job but keep their income? It's like, well, someone needs to be responsible for the full 3-statement model, not just the income statement, but someone that's like, okay, maybe that extra 100 or that extra 50 or 100 is coming with distribution. Like if the owner makes their distributions, they get a cash bonus. And then they're focused on, I talked to this one guy where it was like, working capital was a huge component of their comp plan, right? Receivables, payables, inventory, and then equity valuation through debt because you don't want them to finance it. But like there's this, I just completely believe that this component, Craig, of like finding someone that's the CEO and using your system to like comp that person. Every one of these people are like, I just want to sit at my cabin in a skid loader, bulldozing trees down. Or my other client is like, I want to go hiking and I don't have to think about this shit. And they don't have that peace of mind unless all these pieces come together. So I don't know if that was a lot, but I want to just tee it all up and put the context around it for you.
Yeah, no, you're right on target with the thinking out there. And like you were alluding to, the name VisionLink, right? That's really the design behind it. Is you need to link the vision of the business along with the visions that your people have within the organization, and get them to realize that if we can drive towards that company vision of where we want to be and where we want to end up, and people can see that it's going to help them achieve theirs, either personally, professionally, financially, whatever that is, you're going to have a much better chance of achieving that, right? And so our view at VisionLink comes from the compensation side and the total reward side. And so how do we help link those together? Not saying it's the only way, right? I always like to say that I'm a compensation guy, and I'd love to say that this is, if you can do it all through comp, but you can't, right? I think you have to paint a picture for people first. We call it the compelling future, right? Is people need to see the future. It's got to be compelling to them. They have to see how they can contribute to that, how they can be a part of all of that, and then design your compensation strategies around that, right? If you can link your ultimate outcome back and into these compensation plans, much greater chance of achieving those things together.
Yeah, and I want to. Well, I want to unpack how you guys do this, because you and I have had, and we'll have the previous episodes that you and I have done in the show notes, but because there's a lot of there's a lot of things that we're building on top of here, Craig, and I think that is completely possible. But it has to be the right goal, which is what I've spent a decade focused on. What is the goal? Well, every one of these owners, if they want to make 20 to 50 grand a month net in distributions while someone else runs their company, just like private equity firms do, while they're growing the value of the company, they have to have their own goals and their own clarity first before we then stack on all the stuff that you're doing. Because you and I have talked in the past, I think a lot of times I can't even imagine you guys are going in there and I need an executive comp plan. Where are you going? I don't know. But effectively, they're probably just saying all these different things to say, I just want to get step back, but I don't know how. So when you talk about linking the vision and linking the comp plan, why don't you explain to me and everybody again, what are the different components? I think you said there's regular benefits and there's short-term, there's long-term. What are the different categories of comp plans?
Yeah, so I think it actually is going to start with what we would call a compensation philosophy statement there. I think most business owners have a fair idea or a good idea of where they want to go, right? Hey, here's where I want to be out there. And ultimately, then we need to say, well, how are we going to design our compensation approach here, right? There's a lot of different things that businesses can use, right? Whether it be from cash compensation like salaries or base wages, like short-term incentives. When we say short-term incentives, we mean something a year or less. It can be a quarterly bonus plan, an annual bonus plan, but something that's cash-based. There are equity plans. Do I want to share equity here? Would I rather it be a cash-based long-term plan like phantom equity? It can be either of those. Then I have all my benefits side, right? I'm providing medical insurance and dental insurance and vision insurance and a 401k match. And you start to get in all those things. Well, you have to decide where you're going to spend those dollars, right? Because we can't be above the market in every single category there. We'll go broke. We'll go broke. And so ultimately,
let me interject right there for Craig, because I agree with you, but also and I'm curious to hear your feedback over the last couple of years since we connected, the difficulty of finding these. Is it 200 now that's A players, or is it 250 and 300? And I say this because let's assume for this conversation that I'm coming to you and I'm saying, Craig, here's the deal. I've got my target equity valuation with my normalized EBITDA clarified, my multiple that I want to get to, and my debt, so that equity valuation's clear. And I need, as the owner, to make 30 grand a month net in distribution. So now we have to back into working capital, the cash, and all that. And I say this because I don't know, man, I'm willing to overpay for someone if actually they do their job. In these, because my point is when you say we don't want to go broke, but let's assume we're not going to do anything that impacts that 30K a month and that valuation target. How there's that? What are the availabilities? Maybe even overdoing it.
Yeah. I think our philosophy is that we want people to understand that if the business does really well, they're going to do really well, and design compensation strategies that do that. And I think the overarching one would be this for a business like you just described. It would say that, hey, I want to be able to pay you somewhere around market-based salary, maybe a little bit below, maybe a little bit over, but somewhere at what we would call the market median for salary for a position like the CEO we're trying to replace. And then we would say we were going to provide a short-term opportunity, meaning an annual bonus opportunity that might take his cash compensation up to the 75th, 80th percentile when the business does well. Now, when defining when the business does well is going to take into consideration those distributions, right? We need to hit this level of performance for you to get that. And that already includes your distributions as the owner in there to get
Okay.
it. So we get to engineer it, right? So we get to say, what's the performance requirement for me to get to that 75th percentile? And if we don't hit it, it doesn't mean I won't get an annual incentive. It just might be a little bit lower depending on that performance there. But I think the message we want to send there is, we want to have a compensation plan that rewards us for growth, for having the business produce profits annually. Okay. That's what your salary and your bonus is for. Hey, operate the company on a profitable basis for us. Here's what you're going to make. And then create some long-term compensation for that person. So all businesses have short-term goals and long-term goals. And so if you have both, why wouldn't you have compensation plans that fit both of those? That's where the long-term piece fits in there. But the long-term piece is something different. It's to say, let's grow these profits. Let's not just produce these profits, because I'm paying you for those already with salary and bonus in our current situation. This long-term plan is saying, grow my equity value, grow my enterprise value out here in the future, and I'll share some of that value with you if we can do that.
So, and that's super helpful. And I think defining those KPIs is like, I mean, that's where, like, I think when I'm forcing the people that are listening or my clients, like, we have to know this stuff before we even potentially recruit or succeed someone. And let's talk about, before we get into even more mechanics about how the plan is designed and different ways to engineer this stuff, is the possibility of, like, this CEO, and that's one of the main components. You and I will talk a little bit more about other executives, maybe departmental functions and stuff. But, like, Craig, like, I think one of the biggest challenges that the people that I have come across are dealing with is, like, I don't know if it's possible for someone else to do this shit. Like, I'm going to have to always worry about it, because if I hire someone for 200 grand, I put them into all this stuff, like, will I be able to sit at my bonfire without logging in this week? Right? I mean, and have someone manage the costs of goods, the working capital. And I'm just not this true believer that if we say, okay, here's what we need: normal receivables, payables, inventory, margins, and all this stuff, and, like, plopping this in front of someone with your plan design, it's the capabilities plus the incentives that, I mean, going back to your link, right? I mean, you guys did a good job with the words. But what speak to your experience of watching someone execute that and actually do what I'm saying.
Yeah. What I think that goes to is, everybody always says, hey, we need to have a compensation package to attract people, right? To attract good talent. Well, what I would say is the answer to that is, we want to attract premier talent, right? For the role you just described. If I'm going to step away and smoke my cigar at the bonfire here, I need to attract premier talent that's going to be able to execute what we're asking them to. And to do that, you need to create an opportunity for them. They need to see the opportunity there. It needs to be real. It needs to be quantifiable. The results that have to happen need to be clear and easy to understand. They do need to be achievable. We can't set something way out of bounds here for somebody and have them roll their eyes and saying, hey, you're going to pay me a $250,000 bonus if we do X, and I know there's no possible way we can. So we can't do that either, right? We need to make them clear, achievable, and then we need to make the reward meaningful to people, right? It's kind of those three things design almost all of our plans for us: clear, easy to understand, achievable results, meaningful rewards. If you have those three things in the design of any incentive plan, I think you're going to have a good chance for it to be successful. And so sometimes, though, we might not be there right when we start this, right? So when we put all those factors together that you just said, we need to have this much in distributions, and I need to produce a incentive for this guy of this level, we might not be there yet. The numbers may not pencil out yet, right? So when that happens, what do we have to say? Well, sometimes we have to say, let's add this long-term piece to this so that it's not a reward right now. It's not cash today. It's a promise to be fulfilled if we achieve certain growth results out there. And so marrying that short-term and long-term incentives sometimes is required in the early years, because our short-term results might not be able to meet all of what we hope it can meet from a cash standpoint.
Makes sense. And I think maybe where we could go with some of this is like how to engineer it based on the clarity of someone's goals. Cause I think that's where I'm coming at it is like, we should be I'm essentially expecting that we're very clear. Like we're very clear on what we need for, I mean, and I keep going back to working capital, Craig, because like, that's where all the cash is, right? So everybody else is using you as the bank or you're using everybody else. So like, you know, I'm working with a couple of people right now with like millions of dollars in receivables. It's like, yeah, it's not yours. Like if you had that in your bank account, you could take a distribution, but you don't. And so and then another one of my clients said, hey, you know, like my cost went up 5% and that'll be hundreds of thousands of dollars this year. Who else is going to care about that stuff? And it's like, well, that's why I go back to the kind of the baseline ownership's goals of like, if we have a certain amount of distributions, working capital and how we're going to fund this, we should be able to layer that clarity onto this person. So that way they have to be capable, like if you said, like premier talent, but then they should be able to, they should know what to do with this if there's things getting off balance because they will be positively or negatively rewarded for it.
Yep. Yeah, I think from the short-term incentive plan standpoint, we need to focus on that year's operational results that are going to produce the operating income that we need to pay distributions, to pay bonuses, to pay all of those things. I think the other things like receivables and working capital and all of those to me are the price of admission for a good CEO or COO.
Everybody listening is sitting there going, thanks, Craig, but like, where are these people?
Yeah.
You got to go find them. But I love how you said that. I agree with you.
Just like you said, I don't want them just producing this number that is, you know, not realistic, not sustainable, right? Really not sustainable over a period of time there. And so perhaps those are additional, what we would call KPIs, like key performance indicators that might affect a person's incentive, even though they hit the numbers. But when we look behind the drape there, we go, but this, and this. And so,
well, let me pull back. One of the this, and this could be they hit the revenue and then the margin, but guess what? They gave it away at 90-day terms or like whatever it is that is. I mean, it comes back to that cash flow machine that is behind the drapes, which is like the owner has to be able to make those distributions. It has to be a healthy company. And I like how you just said price of admission. I mean, but because I agree with that.
Yeah, I think it is. But you know, we do want, look, I think most incentive, I don't think all incentive plans have to be based on profitability. You can't pay incentives without profit. Okay. That's just a function of the game. You can finance them for a while. And I've seen business owners do that early when we're trying to attract the people and go, and maybe we're not at the profitability level we want, but I still like this person and I want to drive value with this person. And so I might, but I can only do that for a certain period of time. And so the ultimate metric in an annual or quarterly incentive plan needs to be profitability. We can affect that person's actual reward by some of these other things like, you know, accounts receivable, the 90-day, all those things that might affect it because we don't like, or we do like, maybe they're really good at it and that's what's driving it. But we're always going to create some additional KPIs to look at potentially for people. Now, the CEO, you get some argument that guy's job is, hey, produce this level of profitability and do it the right way because it'll be sustainable.
Yeah, I hear you, but like, I did 43 Vistage workshops. It's been 45 in the last 15 months. And like revenue, net income. And like, it doesn't mean shit. And I say that like, for all tongue in cheek, because like the people that are backed by private equity firm, like there ain't any other way. It's like, this is your internal rate of return, distribution. I mean, like it's very clear. ESOPs, hopefully have a better shot at being more clear on this stuff because it's all about the ownership's goals. And what I'm trying to do is for these owner operators who've been stuck in the operations, looking at their VTO, aren't paying attention to this stuff because and when I say this, Craig, is like, someone backs away and says, hey, yeah, profitability, Ryan, go for it. But then all of a sudden they have no cash for taxes, for reinvestment. So it has to be all these three statements and it becomes, I don't know, Craig, like everything went up and to the right since the Fed hit the money printer in 2008. And now things are a lot harder. So I think this cash flow working capital, and that's why I'm beating this drum because it's that mindset to go, oh my God, someone actually is having healthy growth. And you said sustainable. And like, let's talk about like, okay, before we get to the long term and how we can tie that into people's long term, for the short term, let's say it's a combination of like working capital, maybe distributions, but also like the right strategies of investing. And I say that because like something like essentially a normalized event, like implementing an ERP system, like it uses cash, but it should grow the multiple. What are the different ways of engineering those incentives and KPIs for a total of like, hey, Ryan gets 100 grand if these things happen, but how do you have a mix and match of that?
Yep. There's a couple of ways that you can do that, right? So we can have multiple goals that we parcel out. So most of the short-term incentives going to be expressed as a percentage of somebody's salary. So I'm the CEO. Let's go back to your CEO. I make $250 a year in base pay, and you tell me I have a 40% of my salary opportunity this year for short-term incentive. Okay, that's 100 grand. Okay, that's usually how we're going to express it. That way, as my salary grows, my incentive can grow, and sometimes even that percentage can grow. And then what we're going to say is there's a couple ways to do it. We can say of that $100,000 that you have coming, 50,000 of it's going to come from net operating income number here, goal that we're going to pay you on. So that's half of it. 50 grand's coming for there. And then we might say 25% of it's going to come from a working capital metric, right? And so design that metric of what's there. And the other one could be accounts receivable, right? Another 25% accounts receivable. So they're independent of one another. I might earn the profitability one and I might miss on the other two. I make 50 instead of my target 100. Okay.
Yeah. And going back to, I like that because, if you have net operating income, working capital, and I think there's this other one, which is both short-term investments and long-term growth, where like it's the sustainable nature of that cash flow, Craig. So like I'm helping people see like if they're picking their EOS rocks, like don't pick random shit. Like pick something that's going to de-risk your cash flow, but it's a use of cash. So think about like the complications. So if this is me and you're saying that, I'm going, okay, well, net operating income, if I spend the 300 grand in the ERP system, I get screwed. Which is why I think I would argue it's normalized EBITDA, working capital, and then the health of those investments to say like the ERP system is a one-time expense, so I don't get dinged on my 50K.
Yep.
Right, but then somehow I'm incentivized to de-risk the cash flow to grow the multiple. So you can almost have the short-term cash flow, the annual one be immediate cash, but it's also benefiting my phantom stock once we get to that as well.
That's where I was going to go, right? Is we can take some of that. You're right. The owner has to invest, right? The owner has to invest to grow his business. So why shouldn't the CEO have to participate in that as well, right? Mm-hmm. The risk in my first example you have is that we don't meet the profitability goal at all. In fact, we might fail totally, but we still might meet our accounts receivable goal or our working capital goal. Unlikely maybe, but it's still possible. And so I have no profits to pay you from when I do that. Right. So it's just doing that methodology. Got it. The one I tend to like a little bit better, the same three goals, except we basically just say you have $100,000 opportunity and it's going to be based on profitability and these levels of profitability. We hit budgeted profit for the year. You qualify for your 100 grand. Okay, doesn't mean you get it yet. You qualify. Okay, meaning we hit the goal. Your 100 is now in play, but now we modify that 100 based on our goals for working capital, our goals for accounts receivable, what are there, and it might make that 100 go up or go down. If you were really lousy at the other two, might wipe out the whole 100. Okay.
Interesting. I like it.
Yeah. If we did really well on them, might make it go up above the 100, but at least I know the profit was there to fund that plan for us.
Oh, I'm thinking of like for some reason I just went straight into the gambling of the fishing and hunting trips. If you ever play 654?
Yes.
Do you quali? I love it.
Yeah.
I love it, man. I like that a lot because you're saying like here's the main goal, but like, dude, when I got into the family business, Craig, we were actually paying all of our sales reps on. They had revenue based business or bonuses sometimes, and then I'm like, we owe hundreds of thousands of dollars. And we have no cash at all. Like, I want to be one of our sales reps and not one of the owners right now, and it's just absurd. But that's super fascinating.
Yeah. So like the modifier approach to it, but then I think to where we were just going right before that is one of the main reasons you would have a long-term plan, because the long-term plan, as I mentioned before, short-term plan is based on 1 year's worth of performance. The long-term plan says we want to grow and make this bigger. This plan, this long-term plan is about growth, meaning if we stay at the same profitability level for the next 5 years, my long-term plan should have zero value. Okay, because it's about growth. It's about increasing value and
I love
enterprise
that.
value. It's not just another compensation plan that we're giving dollars away on. It's based on growth. And so I want that to be balanced. I want that CEO making decisions that, wow, I could make this decision this year and jack my bonus up, but my chances for growth now are way down here because I didn't invest any money and I do anything here. Now my long-term plan is not going to be worth anything. I want him always balancing those in his decision making because he's tied to the success or the failure of both of those.
Craig, I actually think I got it from you because like every single time I do one of my workshops, so I'll explain to you what I say to people because it's my philosophy that I'll go to the grave with, which is, okay, so if your goal is $1 million in normalized EBITDA, no debt, and a 5 multiple in 3 years, your target equity valuation is $5 million, right? And I'm your CEO. And then if my desire for long-term equity is $1 million, our new goal is 6.
Yep.
Because like, and I say that, and like, so I say that because then people, I hate it, and I think you're the one that said this, is people say, well, I need to give this person this equity. I'm like, don't ever freaking say that ever again. Are you a charity? Don't give anything away. But like the $5 million is your hurdle. Right. So then everything else is like, and there's some shared upside on that. Like we're tying ourselves together on that long-term equity play.
Yep. Yeah, for sure. I think it goes back to the concept I'm describing here, which is the plan should be based on appreciation above something. It could be above today's number. It could be above your goals number. You can structure them in a lot of different ways, right? Where we're saying, okay, today we're at equity value of 2 million and we're trying to get to this 5 million is my number I want to get to. So we've got 3 million of appreciation built into our plan over here. As a business owner, I'm going to be much more likely and liberal to share that 3 million than I am the existing 2 million we have right now before we even hired this guy, right?
Yep.
It goes with setting some what you would call strike prices if you were using options, or base prices that you say, hey, you're going to share in 10% of this first $3 million that gets us to our 5, but between 5 and 6 value, you might share 20% or 25%. So you can structure that by the strike prices or base prices or grant prices, whatever you want to call them, of the awards.
We're gonna unpack that because I think that's some of the meat that I want to get to, because let's talk about, I'm trying to think of the best way to unpack this, given the conversations I've been having, is one is like how, like, and maybe I'll tee this up and you can pull this thread however you want, but like people get concerned if I don't want to sell, it's like, well, just put the liability on your balance sheet and then we can figure out different ways to get that money to the person when they retire or whatever. So like, this doesn't have to be part of selling, but I think, when you talk about like the different strike prices and how we like engineer it like that, before getting to that, Craig, so here's what I've been saying to everybody about the valuation. And I think that's going to be one of the big key components with my Independence by Design ownership framework is like, okay, so you have your 3-statement model, you have your goals clear. So like we're getting that short-term stuff, like got it locked in. Now we're getting to this long-term play. What the hell is the company worth right now? And then what's it worth long-term? So I'll explain what I'm saying to my clients, which is there's the cash flow valuation and then there's the strategic valuation. Strategic is like estate planning discount or third-party premium because they got the company. You're just never going to know until that buyer shows up. And you and I are talking specifically right now, just managing the company every single month with short-term and long-term alignment. And so what I say, Craig, to people is like, yeah, like we can go get a cash flow valuation, from various people. But I want to talk about how you do it, because like what I've been saying, Craig, is like instead of going and getting like some $30,000-$40,000 valuation that's just so subjective, is like, I say, how much debt could you afford to service while taking the distributions and growing the company without throwing up in your mouth? And then like that right there, and if you times that by 120 months, is technically an SBA valuation. I'm just making it up so people can like back of the napkin like go, oh, like it's like the seller, because you can convert that effectively would be your distributions that you can convert to debt, you can convert to an SBA loan, whatever it is. But like, How are you looking at these valuations? Because from the cash flow perspective, and I can't remember what you said last time on one of our calls, it was like, you don't want to like overdo it because then you're vesting people in, and there's different, like there's almost so much creativity. What I'm looking for is like a mental model for how people should be thinking about the valuation process, and then how people are vesting in based on, like you said, the flexibility people have.
Yep. So like when you start thinking of, and I am basically addressing a phantom equity plan here, not an actual equity plan, right? So let's get those clear. If we use actual equity, IRS requires that we get a fair market valuation done. Okay, because there's taxes that are due and they want it paid on fair market value. One of the main reasons we often jump to phantom equity is to get rid of that, as well as some of the other negatives, like, a bunch of minority shareholders and, all the things.
Fiduciary obligations. And by the way, why would all them want a K1 anyways to pay their taxes? Like, if done correctly, this is a better flexible approach anyways.
It's tracking the value the exact same way. And so there's a fundamental decision once we decide, hey, phantom equity is the right approach for us here. And that is the monetization of the phantom equity for the participant. When can they do that? What events trigger that? What timing triggers that? If you're saying that my goal is to sell this business in the next 3, 4, or 5
I want to pause you. But like before we get to the monetization, so yes, we're talking about phantom. Yes, we're not talking about fair market, but like, how do people get to that valuation? Or maybe I'm jumping. Okay, sorry. Okay,
getting right there because, and the reason is this: if we have this short-term goal of selling the business in that period of time, the only event that we might pay people for that phantom equity is the transaction.
Got it.
And if that's the transaction, we don't need to have a value today, and we don't even need a valuation methodology because
that's the goal. We'll get the goal,
and we're going to share that value when it happens, regardless of what it is. Okay. Now, if I start to tell a CEO who's a really high-level talent, premier talent guy, that the only way you're going to get paid is if I decide that we're going to sell the business, and then we get out there 3 or 4 years, he's done a great job, and you go, the cash flow's
Hey,
awesome.
Craig, thanks for the $1 million distribution. I'm good to go, dude.
I'm going to keep doing this, right? And then my kids are going to keep doing this, and I didn't give anything. And so what has to happen is potentially other monetization events, and thus we need a valuation to value the company for those, okay? And so that's saying that, hey, in 5 years, if we haven't sold the business, I'll pay you. You're vested, and that means you're entitled to the money. And so when we're doing that, we can't stress the business too bad with some ridiculously high valuation methodology, right? In fact, I say it doesn't even need to be market value, what we think market value is, because I'm sure lots of your business owners get calls from the investment bankers constantly saying, I can get you a 9, a 10, a 20 multiple, right? And so, and you can imagine what would happen to our cash if we had to pay a participant something like that from a valuation perspective. So what we say is choose a conservative valuation methodology. There's no requirements in phantom plans for valuation methodology. You can go throw a dart, you can pull it out of a hat, or typically what we're going to do is use an EBITDA multiple, right? Use some sort of EBITDA multiple, generally accepted, conservative to the market. If you say, hey, typically we use, most of in our industry are a 6 multiple. In a phantom plan that might have to pay people before an event, use 4, 4.5, or 5. So it's conservative to that. Track that value over time, measure the improvement. If a person's vesting in it, just like you said, that's going to create a liability on the balance sheet. So create that liability on the balance sheet, make them produce enough cash to potentially even fund that liability along the way, right? So you might start making them earn enough to set aside some assets there to match that liability. So the cash is there when it's necessary.
Yeah, I want to get to that. But hold on for a second, because I think that's a really important thing we need to unpack to help people realize that these options for the owner are possible. I also want to cover like, how do you not undervalue it, where like if I'm the CEO, I'm going, whatever, dude, like you just like undervalued this thing. So like I want to get through the alignment and skepticism that both parties might have. But Craig, I think about like, I like normalized EBITDA on the multiples, but the investment bankers go by, and I know you could like, and based on your flexibility you're talking about, you could do like, big capital investments and stuff like that. Warren Buffett doesn't like, I always say like, well, 90% is normalized EBITDA in the multiple. But like, I think what's fascinating, Craig, and what I've been advocating for is like, if people have a mathematically tied together 3-statement model, and then like you said, okay, well, you want your 30 grand a month in distributions, like, we're growing, and if we have our strategic plan built out into our income statement for the next few years and how much that's going to cost, we should be able to literally say like, well, how do we flip those distributions and profits into debt and then times it by 120 months. And that's literally the SBA. It's like how much debt service you could have. And then how does that kind of reconcile with that normalized EBITDA multiple? Because it's the actual constraints of the company. And so I think it's very fascinating where like if people have that model built out, they don't need a lot of extra complexity behind it because they have kind of their answer in front of them.
They do. And it's one of the reasons we do stay close to those normalized EBITDA multiple valuations, because they're self-funding or should be self-funding, right? If we're not creating value without the earnings to create that value. And so, that's often what we want to do. To protect the participant, that we're not undervaluing it so much for him or her, and that which can come up here is twofold. One, it goes back to those three things that I said at the very beginning about any plan, and that's clarity, achievability, and meaningfulness, right? Which is what we would get into with that question, is that whatever this person is going to have has to be meaningful. We can't have a CEO making $250 a year and $100,000 bonus, and we tell him if we grow enterprise value by threefold that he's going to have another $100,000 in his long-term plan on here, right? It's not going to work. So it's got to be meaningful. And there are metrics that we help you look at and say, right, if I got I'm going to put in 5 years and triple our equity value, I'm going to want some multiple of my annual comp, right? If my annual
interesting. Yeah.
If my annual comp's $350 a year, hey, I probably want at least $1 million to $2 million out here if that performance warrants it, right? So we can look to things like that, but the value has to matter too. So I can't pay a guy $2 million if we only increased our enterprise value by $3 million. And so we got to look at the other side, which is typically you're going to see shareholders being willing to share somewhere between 10 and 20% of the increase in the enterprise value.
Super fascinating. Because like what going back to like the conservative nature of like the how the plan is being designed around, like, Craig, it's exactly what I'm saying. Like, that's what the owner who hasn't sold yet should be planning their entire life around anyways, right? Like, instead of like planning your retirement or your exit on some bullshit number, why don't you tie it to the same thing that your executive comped on? So I think there's like this expectation setting. And then interesting that you were saying like, like a multiple of salary. But I think is there any, because like I think you had already said it, but like going back, if it's $5 million at the target, and then it's like, I want $1 million, then it's $6 million. Is there any kind of like ratios of seeing you like where it's like, what is achievable through that? Because like you shouldn't give anything away if you're already going to hit the $5 million without this, right? Like
that goes to a real simple question that I always ask people, because we always start with where are you headed? What kind of growth potential do you have here in this business? And then can you achieve that with anybody sitting in that seat right there? Can you just pick out anybody? And if that's true, you don't need one of these plans, right? You don't need it. Right. You're going there already anyway. And so I know we say it jokingly, but it's true. If you believe the business is its own engine, is going to drive to that without anybody's help, don't set any value for the person doing that, because anybody can do it. That's not usually the case. Right. And it's not usually what these business owners are after. They want to put somebody in there, and they usually want to share some value there. And the more value that gets created, the more of it you typically share. So if we only get to 5 million, we might only share 5% of that, right? We might only share a smaller percentage, but everything above that, we might be sharing 10% or 15% or 20%.
It's almost just like an investment banking sliding scale, right? Like
absolutely.
Oh, fascinating. Yeah, duh. Because like you're just like, okay, well, it's 2%, anything below $15 million enterprise sale. But then like the more we get, the higher the percentage we get, but the overall lower the total percentage. There's just an easy scale to be had right there, right?
Yep, there absolutely is.
Awesome. Fascinating, dude.
And I think what we like to say in here, as you think about it too, I think people often come into this and are thinking about this in general of, I hire this CEO and I give him what he's going to get. Okay. Meaning, hey, I'm going to give you this percentage right now, and it's going to either start vesting or this is just what you're getting, versus actually using it as part of their annual compensation package, right? So that I give you potentially, you earn some of whatever it is. We'll call them phantom shares for now. You earn some every single year. Right. So you earn them. There's a couple things that happen that are advantageous for the business. The first is every time I give you a new award, I get to attach a new vesting schedule to it. So I get to keep pushing vesting, total vesting out because it's rolling forward every time I give you a new award.
Can you explain that in a little bit more detail?
Typical vesting you see now is 3 to 4 year vesting cycle. So imagine I give you some awards at the beginning of 2024 and we use 3-year vesting. Well, at the end of 2026, I'm going to be vested in those awards you gave me at the beginning of 2024. And so if I gave you everything I was going to give you at the beginning of 2024, well, then you're 100% vested in everything the end of 26 versus I'll give you some more in 2025. Well, those don't vest till the end of 2027. And I give you some more in 26 that don't vest until the end of 2027.
Can we put, I'm tracking it. It's like a bond ladder. You're just kind of ladder or dollar cost averaging or whatever you want to call it. So could you say okay, so if it's me, I'm your CEO, 250, and I want to earn, I don't know what a normal, if it's 1%, do you have that 1% that then vests over 3 years or
Yeah, you might just chop it up. If I was going to if you've budgeted for me 1%,
let's say it's 5. I don't know what it is. Sorry to interrupt you, but for some reason, I don't know if it's 5 to 10% because it's if you want to get to your new target equity valuation in 5 years, I don't know. It just seems so practical. It's okay, 5 years, you get 1% each year, Craig, that we're doing this in. Yeah. Do you have each of those percents invest over 3 years? So you have a cent. Okay.
Yeah, typically. But you have some acceleration events built in, meaning if at the end of year 4, we sell the business, well, we'll accelerate your vesting on all your existing awards up to 100%. So you don't forfeit anything if we sell the business. Okay. So you have some
just like an ESOP. I mean, an ESOP, when you sell it, everybody gets fully vested and they get paid out.
Everybody gets fully vested. Same thing here. Okay. The other thing it allows you to do is if you're using appreciation awards and setting base prices or strike prices, and imagine we're growing like this each year, I get to set.
Can you explain that again? That strike price and base price.
Each one gets a little higher strike price, so even though I might be in the money on some of the awards you gave me 2 years ago, I got a new bar. So if I want this one to have value, I got to keep growing the business.
So going back to my 5% over 5 years. So you're just valuing the business, right? So that's what you're saying with the strike price. You say, okay, so on year 1, I get 1% that's vested over 3 years, but it's at this price. That's and then year 2, the company is revalued. You get another valuation, and that vests over then 3 years. And is that essentially what you're saying?
And so we would actually give them, if you really wanted to equal 5% of the value.
No giving.
Then we need to award them more than that because these are appreciation awards. They're not fully dilutive. I'm not giving you anything on the current value, right? And so I'm giving you, let's just say I give you 1% a year. What I'm giving you in the first year with an appreciation award is 1% of the growth above this level, right? Okay. Next year, I'm giving you 1% from this level and up. That doesn't totally dilute 2%.
Can you throw some numbers around there just as an example?
Yeah. Just imagine we started and the enterprise value was $1 million and I give you 1% and we end up at $5 million. I get 1% of the $4 million of growth.
Okay. Got it. Yep.
Okay. Yep. If I do it in the second year and now we're valued at $2 million, I'm only given 1% of $3 million of growth there because there's a new starting value. Okay. And so depending on right now, we're doing this there's this static point that says 5 million is going to stop, but these awards don't stop. So if the 5 million goes to 8 million, goes to 10 million, I'm always getting 1% of growth above where I started to wherever it is that I finish in appreciation awards. If you had an agreement with your CEO that you said, I'm going to share 5% of the value of the business with you, then we use full value awards, not appreciation awards. And a full value award is just like you said, here's 1%. It's of the whole value of the business, whether it's 1 million or 5 million. The risk with that is you just gave a CEO 1% of the value of your business. And if he doesn't grow it even 1 iota over 3 years invest, he gets 1% of your business out there and didn't grow.
I don't know if I fully, that's super awesome, Craig. 'Cause I don't know if I fully understood the difference between appreciation versus full value awards, to be honest. Yeah. And so then if you layer on the accelerator in the middle of that, do you layer the accelerator on top of that? It says that because if you're hitting these, you're accelerating. So maybe not 1% of that appreciation, but maybe it's then if we hit this, then you get 2% of the appreciation. Or is that
you can do that as well, right? You can do what are called performance vesting as well, right? That says if we hit 5 million in 3 years, your 1% turns into 1.5%.
Okay.
You can also say, like, sometimes with full value, with appreciation awards, what I like to say is the performance is already built into the design of the award, right? If we don't grow, you don't get anything. So the performance is built in there. Whereas with a full value award, it goes to what I said before. You're sharing a portion of the existing business plus the growth in it. And so sometimes you'll put a performance requirement on those full value awards and say, these are going to vest in 3 years. But if we haven't grown at least 5% a year, it doesn't vest at all. You forfeit it even.
Yeah, you're kind of backing into that performance part of it. So fascinating, dude. I just love it because and it's very difficult. And sorry, a lot of different thoughts going through my head. I want to make sure we get to then how the asset or how the liability is managed and dealt with. But before we get there, I just want to make this comment, Craig, because I want to hear your thoughts about how you handle this with people. Because it's for spending so much time in here in this space. It's like, if the more clear people are on what the hell they're doing and where they are and how to manage their company as an asset, like they can actually do almost whatever their mind can think of. I mean, especially because that's what you just layered on is like, as long as they're clear on their goals, like you can organize this to make sure you don't screw yourself, you don't screw your cash flow, you have a complete alignment. How do you with education, I think, is the biggest friction point behind this, which is why I love doing what I'm doing. Like, how is it when you sit down in front of somebody, like anything's possible? And how do you get them to breadcrumb it? You know what I mean? That's why you're on this show, but how do you deal with it, man?
Yep. I like to describe it as it's a blank canvas when we start to design these plans, but there is a canvas. Okay, meaning there are
that's a great way to put it.
There are some guardrails here. There's only so much we can go. Some of them are tax code, right? There's Internal Revenue Code 409A that we have some restrictions and things that we do around payment timing, investing, and things like that. And so there are some guardrails, but we do start with very similar to what you and I have done here, which is, first, where are you going here, right? And what are you trying to accomplish and how are you trying to get there? And then let's build a plan that supports that, right? And making sure that says, hey, if we're going to sell the business in the next 4 or 5 years and we are 90% sure of that, we can get away with building a plan that only pays when that event happens, right? If we're unsure of that, or, perhaps maybe I'm not going to sell the business. I just want to build this thing up and keep building it. And I'll decide when I get there. Now we think of some other things and you just start narrowing down the design features that support those goals and that will help drive them, right? So I really try to get this to people. This isn't just a reward plan. Everybody focuses on the reward, like the payoff, right? I get this much. I want this to drive that performance. I want this plan to drive it. I don't want it to just be the mechanism solely to just hand out money, right? I have to believe it's driving that. It goes back to if you believe anybody in that seat can drive you there, you don't need one of these plans.
And the driving is the actual, it's such a great metaphor, dude, because every one of the people I'm thinking about right now, they're just sick and tired of being the driver.
Yeah.
Right? Yeah. I want to sit in the freaking passenger seat and stare out the goddamn window. You know what I mean? And it's that stress of even and I think there's such a good metaphor there because driving is not work necessarily, it's not, but it's exhausting. If you're driving on a long road trip, it's the mentally paying attention, even though you're physically sitting in the same, you're doing the same thing almost. Yep. It's that driving that should say, if someone's responsible for driving, because the goal is to get here, that's what then allows someone to sit at the bonfire going, I know it's being taken care of because someone's driving the plan.
That's right. And you're going to have a much more confident feel of that if you've created compensation plans that drive that behavior, that make a growth partner out of that guy so that he's sitting in the same place you are. He's wanting the same thing because he's tied directly to it. Now, he's not at the same level, but he's there. And I think that's the key. That's what's going to give you the confidence and the peace of mind to be able to sit there and do that. I don't think you can do that without having somebody who can have that ownership mentality along with you. And they get that through, these value sharing type plans.
So let's move to then, okay. So this becomes a liability on the balance sheet. So Ryan, the CEO, has got $1 million. I've hit my acceleration. I've been driving it, and I've now got $1 million that are owed to me. What's your plan, Craig? like you're now sitting at the bonfire smoking your cigar and I'm driving this bus now. And like, so like, what if I like because I think here's the conversations I think people want to have is like, hey, Craig, I kind of want to retire now too. So I might want to retire. Are we selling the business? We do an ESOP. Like if we do an ESOP, I still need to be replaced. Like I hope that through that ownership and operational alignment that you and I are partners having this like next phase discussion, and it's open without anybody freaking out that one way or another you're going to screw me out of my $1 million or something like that. So how does that taken care of?
So first and foremost, a phantom stock plan is a contractual promise to pay plan. So it is contractual, right? So we define all of the terms, the value, the different events where it happens. And if I am vesting, so the term vesting means I have a legally enforceable right to it. If I'm vested, I do. If I'm unvested, it means I would forfeit it if I have a separation from the company, retirement, whatever we want. And so if I'm vesting in it, then what FASB requires, the accounting rules state that I must accrue a liability on my balance sheet for the value of this plan. Okay, so if it's zero when we start and it gets to $1 million over 5 years, whether it's a straight line or not, I'm in essence, after year one, I've got a couple $100,000 of value that's vested. That has to go on the balance sheet. And when it goes on the balance sheet for the first time, it also runs through the P&L and hits earnings. Okay, because it's an increased liability, not a tax, not for tax purposes, just for your book purposes here, right? And if the next year it goes from 200 to 500, that means there's a $300,000 increase that runs through and hits earnings. Okay. And so I'm going to expense it all the way up until it's time to be paid. And then when it's time to be paid, I get to pay it out as compensation and get my deduction for it. Now,
which is all great stuff, by the way, like from an ownership perspective.
Yeah. And now I have to decide because there's no requirements to fund this. It's an unfunded liability of the company for purposes of the IRS because it's not guaranteed to me. I don't have any claim on assets of the company. It's a promise to pay. Okay. And so, like any other financial planning decision, if we knew we had to buy a building in 5 years and we needed $1 million to put down on that building, would we wait till year 5 and say, gee, we need $1 million to put down this year? Probably not, right? We would say we might want to
go borrow it.
Yeah, we could, right? If we think that, in reinvesting all the dollars back in the business gives us a greater return than setting it aside in a bank account to fund this for the guy, that's fine. There's nothing wrong with doing it. I think what you see, though, is you get much more confidence from participants if they see you're taking the liability seriously, right? And so I think you get a lot more buy-in by saying, let's set some money aside. Remember, this money is staying on your balance sheet, can be used for anything you want at any time you want. So even though you might call this the phantom stock funding account over here that's at, wherever it's at, it's still a corporate asset subject to creditors, all of the other things. It's not segregated money by any stretch here. I see we have many clients that do set money aside. Do you need to set 100% of the value aside? I'd probably argue no, because we've got this tax deduction waiting to happen out here when we pay this person, right? So we pay this person, we pay him $1 million. That just turns into $1 million of tax-free earnings that we had that year in particular. So there's different funding strategies. You can put the money wherever you want. There's all kinds of strategies there. I think it's a financial planning decision for your company. What's the best way for us to fund this future liability that we have?
Love it. Yeah, you got the tax deduction. There's so many different ways you could figure out how to. It's so funny, Craig. All this comes back to the financial forecasting because like everybody's like, oh, ESOP, so complicated. I'm like, repurchase obligations are just a forecast of when you need to pay someone out with just if you were forecasting out your own distributions and taxes. So it's like, it's just effectively whenever I hear people complaining about that, it's just like just doing the discipline of doing the right work. So it's like, but then it's a use of cash. If you have the visibility, what's your best capital allocation of that $1 million? Is it the tax write-off in a few years or is it not? But like going back to then, okay, so conversations around like, because like some of the things that I see people have, it's like, okay, like what if I'm the interim CEO? So maybe throw down a couple of scenarios by you. Is like, actually before I do, can the owner choose to like, because with ESOPs, Craig, you could choose, you get 12 months to choose how you want to do that buyout. Do you want to pay them out in 1 year? Do you want to pay them out over 5 years? Do you have kind of flexibility like that?
You have total flexibility. The one area you don't have flexibility in is waiting until the time happens. We have to describe the payment timing when we give the award, right? So we're going to say something like, if you retire, Ryan, we're going to pay you out in 5 annual installments because we don't know when this is going to be. We don't know what the value is going to be. And we want to have some flexibility in our payment schedule to you. If it's the sale of the business, typically we're going to pay the participants just like shareholders get paid. So if I do a deal
in the waterfall calculation,
exactly for $10 million, but I only get $8 million up front, well, we pay the person like we only got $8 million. And if we earn the other $2 million in the earn out or whatever it is, they'll get paid when that happens, assuming they're still there.
Got it. Okay. Super helpful because I've been talking about this like with ESOPs. I mean, they get flexibility too, but as long as when it's being awarded, that's described, we
have to prescribe that at the beginning.
Can you describe that you want to be flexible?
Unfortunately, no. Right. Unfortunately, no. Yeah. The most flexibility you can get is to describe it as I'll pay 50% of the value up front and 50% in a note to be determined at the time of payment. So I can get...
That's pretty flexible. Come on. Yeah.
Well, the reason we have to pay 50 in cash up front is because the participant owes all his tax, even on the note portion, right? So he's owed $1 million. He's got to pay tax for 400. We give him 5. He only ends up with 100, and now he's got a note for 500.
Yeah. So. Yeah, by the way, I just had a tax mitigation strategist, Roger Roundy, on from Strategic Associates. I need to introduce you to him. He's the most brilliant tax mitigation specialist I've ever met in my life.
Oh, nice.
Yeah. But yay, congratulations. Here's your money. Give it to Uncle Sam. Yep. Welcome to business ownership.
Yes.
Okay, so going after these more flexible conversations, Craig, that quite a few people I'm dealing with, it's like, okay, I'm not sure if my kids are going to take over the business, and there's a gap of CEO skill set. There's not a gap in the business financing or anything. It's more like, Ryan, you're not ready yet. I want to hire Craig to be a CEO for 3 years, drive this plan, mentor you, then Craig, you retire or something like that. Or we're not sure. And I think a lot of this, most people resonate with is just options. Might want to do an ESOP, partial ESOP, private, but I just want to have flexibility. What kind of conversations, if someone's driving a plan where you've got some flexibility into it, there's and maybe there's another situation, Craig, where that's part of this, where someone just wants a job for 3 or 4 years, but then they want to retire before the owner wants to. So that's a lot, but I think it's just kind of
if they're all close to the same. Where I would take that would be, they don't truly need a long-term plan because 3 years is at the shortest end of long-term that we would call, right? There's limited upside because we only have this window of time. And so oftentimes you would structure, doesn't mean you wouldn't give them a long-term plan. It might be a cash-based long-term plan. Forget what happens to the business value over that 3 years. If you stay 3 years and you turn my son into a crack CEO, you're going to get $250,000 when you leave, right? We give some number of the years and build just around cash, sometimes around performance like EBITDA. How much EBITDA was there in that window of time? And we'll share 1% of the cumulative EBITDA or 5% of the cumulative EBITDA or whatever the numbers are. But you make it a lot simpler, usually around simple goals. Because we don't have a ton of growth time, it doesn't make sense to base it just on growth for somebody like that. And if their goal isn't really to grow it over those 3 years, it's to manage it and develop a child perhaps into a role, we would just use a different version of a long-term plan, right? Long-term plans are either equity, phantom equity, or cash. They're one of those three. Probably choose cash in a situation like that.
So it is more long-term, but it's cash-based, not phantom-based.
Yeah, only because our compensation industry basically puts all comp into 2 buckets: short-term, 1 year or less; long-term, anything longer than 1 year. Okay, in practice, long-term incentives are minimum 3 years, kind of out to anywhere from 5 years to retirement, even.
Super helpful. And and let's go just maybe from your experience of these premium players, back to your third bucket, what's meaningful enough for someone to find a premium person that's willing to put 3 years in? Because I don't know, man, 3 years is, I know it's short, but it's long with all the shit going on in industries and things moving around, technology, the geopolitics. So like 3 years might seem like an eternity.
Yep.
So like, what is meaningful enough for someone from a monetary perspective from these premium players?
Yeah. I think there's two ways you can do it, right? So I think I've seen it where you just satisfy, I don't want to say overpay. You pay above the market for salary, right? If the median salary is $250 for this guy, I'm going to pay you $300 in salary. And if the bonus target was $100, I might pay your bonus target $150. So I might make up all of it in cash, right? And say, that's just what we're going to do for 3 years. Or if you're going to measure a 3-year period of time for this guy and give him something at the end of it, I like it to be some percentage of cumulative EBITDA or, something along those lines, right? So you said, hey, over that window of time, the company earned $10 million in cumulative EBITDA. We're going to give you 1% of that, 0.5% of that, 5% of that, some number to tie it to some level of performance there that he gets at the end.
I like it. Yeah, no, I like it because, because you don't want to overpay the salary. We're like $300K. You're like, I don't need to drive the plan. If the kid doesn't work out, whatever. Like, you want to still have that performance metric in there, I think.
Yeah, I think you get driven sometimes by the candidate, right? Here, because if he's at the end of his career, he's going to be a lot less growth oriented and saying, I got to double the value of this business in 5 years than you might a 45-year-old CEO that you're hiring who's doing that. So I think who you're trying to hire and find for that role might dictate what kind of actual plan design you end up with. But you can get down to some numbers like I talked about before. Hey, over a 3-year window of time, my reward at the end probably ought to be 1.5, 2 times my annual comp, something like that to make it meaningful for me. I think if you throw all of these together, okay, and then what does that number mean? How much of cumulative EBITDA would 2 times my annual or comp be? And you know what I mean? So you measure them against each other to make sure you're not doing something that is going to put the company in, financial danger or
out of whack one way or short term or long term, out of whack. Super fascinating. Man, we covered a lot of ground. This has been freaking awesome. So I know we're getting close to our time here. I thought what I was really excited about when we caught up was some of the newer offerings and how you guys are going to market, Craig. And I don't know, because my clients in the Ownership Accelerator, we're going to get you behind the scenes. We were going to unpack a lot more of this, but I don't know if you want to maybe whet everybody's appetite from okay, so what I heard you is you're working more. You had a booth at EOS Worldwide, the EOS conference, so you're getting more into the org chart we spent a lot of time in the ownership and leadership alignment on the top part, which I think is the most necessary part. And then you've been doing a lot more work on the org chart, the functional areas, the KPIs, and then you've also got a tool, because what I thought was so fascinating is there's so much flexibility here, man. That's almost probably daunting for some people, but there's a lot of power in that flexibility. But then maybe you want to spend some time on the mechanics, kind of give everybody the overarch, which is, or the arc of plan documents. What are the mechanics, how this is managed, how your new tool comes into this, because I think it's a lower entry point for some people. And then I don't know if that ties into the EOS, but you kind of jive where I'm going.
Yep. VisionLink was founded in 1996. So we've been around a long time as strictly a kind of high touch consulting practice, right? Where we did all the heavy lifting to get you all the way through all of these design projects, whether it's a short-term incentive plan, annual incentive plan, all of those types of things. About 6 years ago, we started and developed our own proprietary software to help us build these plans. We were spreadsheets forever, and spreadsheets are fun for a little while, but not forever. So we developed software to be able to help for the design process, but also to operate and communicate your annual plan and your long-term plan to your people, employee portal, all those things they could come into, but still full consulting design process. And obviously you talk price point, but what we decided in this and what we saw as an opportunity inside the tool was to be able to kind of pack our 26 years of knowledge into a tool that companies can now use on their own. They can come in with all the helps and all the prompts and all of that. And in essence, design their plan with a little help from us, a little bit of coaching help in there at a much lower price point. Can leave your plan in there and administer it and operate it. Same portal that employees can go into. So just a way for them to design both their own short-term plan, their own long-term plan, and then operate it and communicate it. That's what's missing more than anything else. All right. I wish I could tell you it was, rocket science what I do. It's not. The way your incentive plans are going to truly be successful is if you operate them and communicate them constantly to people in there. Here's what we're trying to accomplish. Here's what's in it for you if we do accomplish it. And if you can do those things, the plan's going to be successful. And the tool we have, the software tool we have, is just an unbelievable tool to be able to do that. Whether you're at a point where you want to do it yourself, or you say, hey, you know what, I still want, the full blown help from VisionLink and consultants who have been doing it for 30 plus years.
Communication. I mean, it's like, there's not enough, because there's not, we couldn't say that enough, because what I see, Craig, and you probably see this all day long, someone puts all this in, and the moment that it's not communicated, what I see happens is there's that room for doubt, and doubt breeds resentment. And it's like when someone's sitting there and it's 4:45 and they're making a decision, it's like, you know what? Screw Craig. It's like, and it's just the opposite of what you're trying to accomplish, because there's just confusion for no reason.
Yep. Yeah. Right. Well, you mentioned EOS, and that we've designed that in the software tool, kind of an EOS incentive plan. Because what does EOS do probably better than anybody is communicate expectations, right? Through rocks, and designing your incentive plan around those is possible inside of our tool as well. And so, yeah, we had a really, really successful time at the conference and meeting a lot of business owners here, and the challenges they tend to have with incentive plan design, I think can be met with either solution we have.
And we won't get into that, but I'm assuming it's just short-term stuff based on the KPIs tied to smaller job, the rank and file jobs compared to the bigger.
You can have your entire. We espouse that everybody in your organization should be in your annual, quarterly incentive plan if it's affordable, if you're at a place that it can be, because it allows you to hold down your base comp costs, right? People make more money when the company does better, right? If you can get that, it's a much stronger comp philosophy for a smaller growing business. And so if we can get everybody into that plan, I think it's a highly effective way to compensate them, because we're only paying well when the business is doing well.
Oh yeah, that's nothing better than well, you're not getting your bonus because we're not really sure. And by the way, here you go. Here's $3,000, Craig, and we got 225 employees, and everybody got $3,000, but no one knows why. And,
Yep.
it's such a waste of money. My God. And it breeds resentment, which is worse, because people just have no idea what the hell is going on.
Yep. Yeah, the tools communication package is great too. You go in there and say, end of Q1, hey, here's where we're tracking everybody right now. It's behind our goal by X, and here's what it's doing to your incentive. It's doing this, or guys, we're way ahead, and here's why, and here's what it's doing to your incentive. So,
are you doing any work with the Great Game of Business, Craig?
Not directly.
Oh man, I should get you in touch with those guys and Small Giants, because I'm assuming you don't have to show everybody your cash position. You're just showing them the KPIs and the things that are relevant to them, because the open book management is so aligned, and Small Giants community is so aligned with some of the stuff you're talking about, where they're already kind of building a lot of that discipline into what they're already doing.
Yep.
So the last part of the mechanics, and then we can wrap up here, is that when you say plan design, I think for the listeners, and it's not just the communication and the numbers, but then this has got plan documents. You have mentioned the IRS codes before, but there's got to be documents, legal contracts associated. That's also part of the stuff that VisionLink's managing, correct?
It is. Yeah, we are soup to nuts, beginning to end in our process, whether it's in our tool directly or a full design project, is you do need legal plan documents for any long-term plan. So if I promise to pay where it's more than 1 year out, I need a document that says certain things in it, mostly around payment timing. So we provide all our clients a legal ready plan document, provide them the agreements that you give to the participants when you give them whatever it is you're giving them, shares in a phantom plan, cash in a cash plan, whatever that is. We give you all of those. We're not attorneys, so we always have you get it out there and get signed off on by your own counsel. But it's a document document that's been reviewed. We've done over 400 phantom stock plans in the last 15 years. So
That's awesome.
we're confident in the document, have it reviewed by your counsel and signed off, but it doesn't need a rewrite is what we like to say.
Yeah. It'd be fun, man. I don't know if you got one of your favorite case studies. It'd be fun to maybe get someone on the podcast to share their story about how they actually executed all the stuff that we've talked about. That'd be an interesting story to have.
Do have some great ones. Be happy to do it.
I don't know, man. Anything else we missed that we should cover? We hit some solid ground there.
Yeah, no, I think so. I think it's don't lose sight of really what you're trying to do, right? Which is design plans that are going to support your business plan, right? That's what your comp plans should do. How they should be helping. They should be drivers. They should create people that we use the term growth partners, where they're understanding that they're directly in relation to the success of the organization, and their compensation will follow that.
And it just slots right into the independence by design framework, where like the ownership in step 3, ownership and leadership alignment, where ownership's goals should drive the operations, but then the operations then drives the leadership then drives the operations to ownership's goals. So it's a perfect name. It's linking ownership and operations. I love it.
Yep. Perfect.
Craig, man, this has been a lot of fun. Very excited to have you in on the Ownership Accelerator, man. I appreciate you coming in. And where can people find you? VisionLink, you guys got a bunch of resources. We'll put the links in the show notes below. But if people are looking for your work, where can they find you?
Yeah. VisionLink.co is our website. And find me there. There's all kinds of places to look at it there. You can find C Rutledge, same thing at VisionLink.co, and then or LinkedIn. It's a great place to find me as well.
I hope you found that conversation valuable and you gained a little bit more confidence that it is possible to compensate someone in a way that completely aligns with your goals. So that way someone is driving the behavior and the operations in a way that you would. Obviously the biggest challenge is finding the person that's a cultural fit, a vision fit, an industry fit, and all that stuff. But I believe that once the numbers are clarified and taken care of, then you can focus on finding the personality fit. I think a lot of times in my own experience is like I focus too much on the people and the emotional fit, and then all of a sudden all the numbers become out of whack. But if we would have had the numbers completely aligned with my goals or my clients' goals, then real magic can happen. So I highly suggest checking out Craig's website. Otherwise, I've got a couple more interviews with him from in the past that are on the YouTube channel that I highly suggest checking out. Next episode is with Tracy Beck. She is the author of the 60-Minute CFO, and her and I are going to be talking about her serial entrepreneur background, how she became passionate about numbers, and why the 3-statement model is necessary to get visibility into the cash flow and equity valuation goals that we're talking about. And we actually even talk about how that becomes the framework for all the things that Craig and I just talked about. So the strategic financial roadmap is part of that ownership alignment and playing the business ownership game so you can rock and roll and do whatever you want with your time. So thanks for everybody for tuning in, and I'll see you next week.